Your initial take, ma'am, on these numbers.
Yeah, we see that just the released data is 5.3%, or Q1's data is pretty delightful. But if we look into that data, we see a mixed pictures of China's economic recovery. First, the aggregate demand is actually slowly recovery. That has been reflected by the Qingmin's transportation and tourism data. Well, we see also some improvement in household income growth as well. And manufacturing is expanding, supported by policies, mainly reflected by those PMI data as well as investment data. But however, the household demand, the fundamentals seems weak, as just stated that, for example, retail sales growth and the year-on-year growth is weakening, although it's weakened from its high base from last year. And then the PMI data in employment as well as household loan data's growth, so all these are a little bit disappointing. And property sector's data, of course, it's weakening as expected, but exports also slowed in March from its high peak in February, but that's also mainly because of base effect and the seasonal effect. The outlook of export pictures could be a little bit uncertain given the that's really much subject to growth resilience in the global market as well as geopolitical considerations. So all in all, we see some upside pressures to our own Moody's forecast this year, but the current performance as well as the policy support announced so far might suggest China may need to do a little bit more work to achieve its growth target this year. Thank you.
Okay, so you mentioned it's a mixed picture. That blowout number for first quarter GDP, though, do you think that's enough for China to reach that 5% growth target for 2024? Is it going to be a pretty easy target to reach this year, or do you think it's still going to be an uphill battle?
Yeah, as I mentioned just now, I think the government still, or the China overall economic fundamentals still need to see a little bit more upside signs to conclude that China will achieve its 5% growth. Yeah. So far, it's fundamental consumer confidence and those, for example, the large infrastructures and investment, these parts, we don't see a clear signs of upside trend. Yeah.
Lillian, I want to ask you about ratings. So one of your peers, Fitch, recently moved, as you probably know. Back in December, you guys moved, and you guys cut your outlook on sovereign ratings here to negative. Since that point, let's say 4 months back now, has Moody's observed any improvements? In other words, can China avoid a downgrade from you guys?
You know that we have changed outlook to negative last November. That actually reflected some of the weakness in China's economic growth as well as in its fiscal and institutional strength, mainly because of the elevated debt, and the government needs to do a little bit more, spend a little bit more. So that would erode its fiscal strength, as well as the potential growth in the medium term is slowing, is trending down. So all these factors is having a negative impact on China's sovereign credit. And we'll continue to monitor it in the next 12 months. Our rating cycle is about 12 to 18 months. So during these transitions, all these economic factors and policy settings will be taken into consideration.
Right. And so can we assume then that if nothing changes within that 12-month window, you're probably going to downgrade China's ratings?
You know that I'm actually, we cannot publicly speculate this rating changes. Yeah, of course, as I said, all this progress is a dynamic progress. It all depends on the policy setting as well as the economic performances.
What do you make of, you mentioned that there's a need for more policy stimulus. I'm just wondering in terms of the fact that they've expanded that fiscal deficit budget. Is that enough for you to at least expect that the eco outlook can improve from here?
Yeah. So the fiscal impulse, we call it total fiscal expenditures from the government announced plans, it's round up about 8.3% of GDP, slightly higher than last year's fiscal spending as a percentage of GDP. So that's not really a big stimulus from our point of view. And then on the other side, the monetary policies the target is to maintain a stable liquidity environment, stable credit condition. So far we don't either see a huge amount of monetary support, and we're likely to see this monetary policy stance maintained like this throughout this year. We see a stimulus in the public sectors, in the consumer side, but largely I wouldn't expect a large stimulus coming along going forward. It's more going to be seen as fine-tuning of these policies, of these existing policy plans. So there is some gaps between its target versus the current support. It really depends on how the government is going to square those investments, square those monies across different sectors. Yeah. So which means that there will be challenges for them to achieve those targets, but it really depends on how they implement those policies.
It seems like they're throwing that money into this new slogan called New Productive Forces, which could serve as new growth drivers for this economy, whether it's EVs, clean tech, the like, Lily. Right. I mean, how likely do you think that these pillars of the economy can be that next growth driver to offset some of the weakness that we're seeing in property?
Yeah, that's a great question. So previous China has property sector, infrastructure as its own growth drivers, right? And those account for approximately half of overall GDP, and also probably more than half of the total investment. But if you compare that with the contributions with the new growth drivers, EVs, renewables, AIs, etc., currently the total contribution from this new growth driver cannot match those from the old drivers. We estimate that even for new EV itself, now it's about 2%, and then by 2030 it's going to grow up to 5% of GDP. So you see that there will be a gap of them. So that will depend on how government would provide a little bit more support to drive productivity and then increase the size of contributions of these new sectors to GDP.